Hello everyone, this is a video preview of the upcoming decision by the US Federal Reserve, which of course comes on March 22, and against a backdrop of high uncertainty following the recent developments in the US banking system and also the spillover we saw over in Europe. However, before we proceed with our commentary, please read carefully through the disclaimers and the risk warnings. Once again, I urge you to read through the risk warning and the disclaimer carefully before we begin. Please note that anything discussed in this video today does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. So let's set sort of the backdrop of where we stand as the March 2023 policy decision by the Fed approaches. Rates currently stand at the range of 4.5 to 4.75%, and this is the highest since 2007, as of course can be found in the Fed's website, this information. And rates were brought at this level after the last policy decision at the beginning of February. That was a 25 basis points increase, the last decision by the US Federal Reserve, and it constituted a further slowing down in the pace of its tightening cycle, as inflation had been moderating, and in fact, Chair Powell had repeatedly talked of the disinflationary process that is underway during the press conference of that meeting. So back then, overall, he was quite hawkish as always, but definitely not forceful enough. And it's interesting, though, that the accounts of that meeting that were released at a later date had shown that other members seem to be more aggressive, and the disinflationary word was nowhere to be found in those meetings. And in fact, some members had advocated then for a bigger hike. In any case, after that meeting, and due to some of the data we saw right after that, there was a renewed hawkishness by the Fed, which culminated, we would say, in his recent congressional testimony earlier in March, where he appeared more forceful, let's say, and actually opened the door to a reacceleration of the pace of tightening, if of course that would be dictated by the incoming economic releases. So what other developments have we been having recently as we head towards the decision of March 2022. Inflation has been sticky. Yes, we have seen progress on bringing down inflation for quite a while, but that has been to prove sticky in space, especially core readings, which exclude volatile items such as food and energy prices. And that, of course, is in line with Mr. Powell's warnings for a bumpy road to bringing inflation down to the 2% target. In fact, the personal consumption expenditures of January showed an acceleration in inflationary pressures, although the most recent data that came in this week in the form of the consumer price index showed another moderation in both the headline and core CPI inflation. Now, another factor that pushes the Fed to keep tightening is the tight labor market. And of course, the previous blockbuster report early in February had sparked a massive hawkish repricing expectation around the policy path of the US Central Bank, although the most recent one this month, although strong, showed that unemployment ticked back up higher from its 5-decade lows, while wage growth is on a monthly basis. So the latest data points around inflation and the labor market, they do point to the need for further tightening, but to also take some of the edge for even more aggressive action. All of the above, inflation, employment, Powell Congress testimony, had reinforced the Fed's higher for longer narrative and expectation for more aggressive tightening. And in fact, CME's Fed Watch tool had come to price in a 50 basis points hike for the upcoming meeting, and rates going as high as 5.75%, 5.75%. However, all of that was before the closure of the Silicon Valley Bank, which occurred last week. And it sparked fears around the health of the financial system and the banking sector overall. After a run on the Silicon Valley Bank, run by the depositors who were withdrawing their money, authorities stepped in, closed the bank, and guaranteed deposits, while the Fed announced a new bank term funding program, offering loans up to 1 year in length to banks, savings associations, and other institutions to sort of help provide a backstop and contain the fallout of the collapse of Silicon Valley Bank. Of course, then we also saw the closure immediately of also Signature Bank, and all these have created fears of spillover. The action by regulators seems quite robust, but when there is a bank run, no one knows how investors, depositors will react, and usually when fear sets in, pressure goes to the weakest link of the system. So we've seen now pressure moving into regional banks, and we also saw a spillover to Europe and Credit Suisse, which came under intense pressure this week and actually tapped the central banks, the SNBs, the Swiss National Bank liquidity, sort of to ease any potential fears. Now, all these factors, these developments have caused a highly uncertain backdrop around the future of monetary policy, and also unraveled during the central bank's communication blackout period ahead of the policy decision. and which will of course be delivered. The upcoming decision will be taken as we are still in the eye of the storm of this banking crisis, let's say. So essentially, these developments have thrown any expectations around the Fed out of the window, and anything is pretty much possible. And it seems like we have more questions at this point rather than answer. So this is the backdrop as we head into the decision, which will be delivered at 1800 GMT on Wednesday, March 2022. And of course, Chair Powell's press conference will follow 30 minutes later and will be closely watched for more insights around the banking sector, around the Fed's intentions in regards to the policy path, and all that stuff that we always follow. And of course, we talked about how before this these developments around the banking sector came to unfolded, markets were very hawkish in their pricing around the policy path and the next move. However, this changed everything because it is quite likely that the Fed will now be more reserved, as it will have to weigh how its actions will actually affect the financial system, and there is a risk of over-tightening, an even more acute risk of over-tightening. On the one hand, it wants to bring inflation down, and higher rates for longer are required for that, according to policymakers' own narrative, but the latest developments definitely pull in a different direction and may need a more light touch, let's say, at least in the near term. Of course, what the Fed will do, no one knows, but in any case, it looks likely that it will opt for a small rate hike or even a pause, and of course, no one can rule out even a more aggressive action and a surprise, perhaps, and even a reverse of policy, although the actions by regulators seem to be quite robust and for now to contain the fallout. In any case, markets are pricing in, according to CME's Fed Watch tool, pricing a 25 basis points increase and a terminal rate of 5.25%. Of course, expectations are still very volatile, and we have a few more days until the decision. And again, at this stage, everything is pretty much in the air. But in any case, according to CME's Fed Watch tool, it assigns the highest probability to a rate increase of 25 basis points at the time we are recording this video. Now, other than that, we will also be looking forward to the updated economic projections and mostly the dot plot. The previous one from December, what it showed was a median terminal rate of 5.1%, which of course implies another 50 basis points worth of hikes from current levels. Now, given the persistent inflation, it is quite likely that they may need to upgrade that higher, but on the other hand, recent developments will put some constraint in that. And the Fed's projections, although they do not mandate policy, but they're usually a good indicator of where the Fed is looking to go. However, given the fact that we're now in the eye of the storm, it's unclear how, let's say, valid, for lack of a better word, this will be, and if they will continue to be a good guide a month out or 2 months out. So it will be interesting to see how this updated economic projection, mostly out the terminal rate, the so-called dot plot, on where officials think the policy path will go. So that's it for today's video. Once again, the decision is on Wednesday, 22 of March, amidst high uncertain backdrop due to the latest developments in the banking sector. So definitely caution is needed. Thank you for joining me.